The types of accounts you leave behind matters more than you think. IRAs, Roth IRAs, even brokerage accounts all have different tax treatment. One of the largest assets that people have in retirement is the money that they've saved up in their qualified retirement plans, money that's stashed away in 401k accounts or IRA accounts. Leaving behind a large IRA can actually create a tax problem. Roth IRAs are actually still tax-free even after you pass them on to your beneficiaries. Yes, they will be required to take distributions, but those distributions remain tax-free also. After-tax brokerage accounts actually get a step up in basis once you die. What this means is that any unrealized gains you have in those positions get stepped up to fair market value at the date of death. Well, those gains are erased, which means those funds can be repositioned or transitioned with little to no tax consequences. One of the biggest things that you can do right now is map out where your money is. We have three main buckets: a tax-deferred bucket, a taxable bucket, and a tax-free bucket. Where are you holding your funds, and what will be the tax treatment of each of those buckets once you're no longer here? If you're holding a lot of money in an IRA account, you may want to consider a Roth conversion strategy. The next thing you should do is consider your spouse. A lot of people speak about legacy planning in the terms of what's going to happen with your heirs or your beneficiaries. Well, typically what happens first is we lose a spouse. Once we lose a spouse, the tax situation changes significantly. We go from a married filing joint status to a single file status if that surviving spouse has no dependents. Well, this creates tax bracket compression. So if you've got large tax deferred accounts like large IRAs, those same required distributions are going to have to come out of the account. However, instead of being in a married filing joint bracket, your surviving spouse is going to be in a single file bracket. And those tax rates tend to be higher for the same level of income. This is a critical step in any financial plan, but especially in a retirement plan. What is the plan for a surviving spouse? One of the biggest questions that people ask when they're planning for retirement is, am I going to be okay? Am I going to run out of money? Well, married to that question is, will my spouse be okay? Is my spouse going to run out of money? One of the biggest impacts we see when we're preparing retirement plans is the impact of taxes on a surviving spouse, because it is a major deal and it is so often overlooked. Without a trust, even a modest estate could be tied up in probate. We've talked about this before on the channel, but you should consider a trust because of its simplicity and its ease to transfer assets. Yes, I know that probate can be a total pain, but think about if you have a trust and you have some ideas about where you want your assets to go and how you want them to transition, a trust may be the right move for you. Remember, wills are taken care of and adjudicated through probate court. A trust can help you bypass that process and allow your assets to transfer quickly and privately. Probate court in the Carolinas could take 8 to 12 months. And that's if you have no issues. If you have heirs fighting, if you have creditors coming in, if you have complications, the probate process could be dragged on and create stress and strife for your heirs or beneficiaries. And we don't want that. Another thing that a trust can do, it can allow your beneficiaries to gain access to those assets immediately, or it can allow you to have some kind of control over how those assets pass, the timing of it, and the amounts that they're able to access. All of this is spelled out in the trust document. So, would your loved ones know exactly what to do if something happened to you today? Want to help your family or your church without giving away half your money to the IRS? Charitable giving is so underused when it comes to tax-efficient planning and estate planning. If you're charitably inclined, this section is for you. First of all, let's talk about annual gift exclusions, right? Gift taxes are one of the most misunderstood parts of the tax code. But let's simplify it. There is an annual gift exclusion that you can give away without even having to report it. This is not because it's some super tax hack. This is simply because the IRS doesn't want to be bombarded with millions of small gift transactions. So for 2025, this amount is $18,000 per person that you can gift without even having to report it on any type of IRS gift form. You can use this strategy to gift assets to your heirs while living. One of the things that I often recommend, if you know or if you sense that your beneficiaries are going to inherit a lot of money, make sure you do some strategic giving to them while you're living so you actually can see how those heirs, how your family members handle those funds. Do they make good decisions? Do they go party? Do they make silly purchases? All of these things you want to know, and it's good to know in advance because once you're no longer here, whatever you've set in motion is going to play out. From a charitable perspective, think about qualified charitable distributions from an IRA account. You can start making these distributions once you're 70 and a half. A qualified charitable distribution works like this. You have money in an IRA, you have a nonprofit, a church, a charity, something that you care about and you want to gift funds. Once you are 70 and a half, you actually have the ability to gift directly from your IRA. As long as you follow the qualified charitable rules, this is not a taxable event to you, and it's an easy way to get money out of an IRA and over to your charitable interest without creating any kind of tax burden. In fact, one of the things that's happening soon is the IRS is actually going to have new ways to report qualified charitable distributions. We use qualified charitable distributions for couples who are already giving charitably, and it allows them to start using those IRA assets and using them strategically for their charitable purposes. And it also allows us to get money out of those IRA accounts because it won't be long and we'll start having to deal with required minimum distributions. I would encourage you that if you're charitably inclined, make sure you look at what you're doing with your estate. And if you have any type of charitable intent, there are so many planning techniques where we can leverage charitable giving as part of an estate plan that not only matches up with your values and allows you to give to charity, but it also makes the estate plan way more tax efficient than it would be otherwise. Want to hear something crazy? Life insurance can actually be one of the most tax efficient ways to leave a legacy. I know life insurance, it gets a bad rap. There's so many different types of life insurance out there. It's confusing. It sounds morbid, but hear me out. Life insurance death benefits, or I should say the death benefits from life insurance, that sounds confusing, but the death benefit paid out by a life insurance policy is almost always tax-free. It's free from federal tax. It's free from state tax. Now, it's possible that if your estate is big enough, you might be thinking about estate taxes. And if that's the case, there's a whole nother planning suite for you specifically. But for most of us, life insurance death benefits are going to pass tax-free. This can create all different kinds of planning opportunities. One, any type of tax-free benefit that comes into an estate can immediately create liquidity. These funds can be used to replace a lost income, that can be used to pay down debts. They can even be used to pay taxes on other resources or other assets that are coming into the estate. So it creates a ton of flexibility where taxes are not part of the equation. If we're using this as a tool, we can create all different types of planning with it. We can decide in advance exactly the level of death benefit we want to have. We can decide exactly what we're willing to pay and determine the death benefit based on a budget. We can even create life insurance policies now that will cover long-term care. And if we don't use it for long-term care, it pays a death benefit to your beneficiaries. It's becoming one of the most flexible tools in the overall planning ecosystem, but it is so underutilized simply because most people look at life insurance premiums as a bill and not as a planning tool for future resources. You've worked too hard to leave your estate plan or your legacy up to chance, or vulnerable to taxes. We work with couples to help them build a plan that not only aligns with their values, but also passes as tax efficiently as possible. Feeling overwhelmed trying to build a retirement plan that supports your lifestyle and actually protects your financial future? We help couples here in the Carolinas build retirement plans that aligns with their values, protects their loved ones, and avoids unwanted tax mistakes. Click on the link to book a call with us today. Have you already started your legacy planning, or are you at just the beginning? Drop a comment and let me know where you are in your journey. Now that you understand how to protect your legacy, let's talk about how to protect your income. Click on the video and I'll see you there.